Hi, everyone. We would now like to discuss the accounting of investments in associates, right? That's an important part for this particular standard. And as we understand, of course, accounting for investment in associates, we also want to include joint ventures as a terminology. Okay, we have discussed that in the initial context that the standard Ind AS 28 is covering, for example, the accounting and other requirements in respect of both the associates as well as joint ventures, and that's how we want to go about it. Okay, now just to highlight the concept again, we said that given this, let's say, percentage holding, so let's say this is 20%, and these are of course hypothetical numbers. I mean, they are not exactly scaled on the timeline. When you look at this range, which is this range, for example, we say that significant influence exists. Okay, so anything before that, we use the fair value accounting, maybe FVOCI or FVTPL, which is Ind AS 109. Okay, and the moment I look at anything more than 50%, we say there's a control, and the moment the word control comes, we say it is consolidated. What you control is what you consolidate. Okay, so when we look at the middle path, significant influence, we say we need to follow the equity method of accounting. We need to follow the equity method of accounting, which actually means that only the share of equity should be consolidated. Only the share of equity should be consolidated, right? So the investor has to only take his share of equity and show it as a part of its investment in the associate. Okay, right? We are saying that the investor would only include his share of equity to measure the investment in the associate. Okay, let's take a very basic, very simple example to demonstrate what exactly it is and how does it really work. Okay, say there is a company X has made an investment of, let's say, rupees 10 crores, okay, in acquiring 40% stake in company Y. Okay, so the initial investment is 10 crore rupees. All right, now we are saying after this company Y has made a profit of 5 crores. Okay. Also, there is a revaluation surplus, right, or recognized through the OCI, the other comprehensive income, amounting rupees 3 crores, right? There's an initial investment of 10 crores. The company has made that associate has made, because there's 40% stake. So we can assume that significant influence exists. So it becomes an associate now, okay? For the lack of anything to the contrary, right? So there's no information about that. So we can safely assume that the significant influence exists, right? So the 10 crore is the initial investment. The other company, Y, has made a profit of 5 crores. After that, 40% was acquired by company X. And also, there's a revaluation gain or a surplus, which is recognized by company Y, right? That could be possible. So how do you look at this entire structure? How do you look at these transactions, and how should company X account for this particular, amount or the investments? So the way it works is pretty straightforward, right? Investment in associate. We say initial investment, which is 10 crores, right? Plus share of profits, which is 5 crores into 40%, 2 crores, plus share of revaluation surplus, which is 3 crores into 40%, which is 1.2 crores, making the total investment at 13.2 crores. Okay, that is what you're doing. You are simply adding the share of equity, whether that equity is a realized profit or it's a part coming through the OCI, unrealized profit, for example. It could be a reserve, for example, like a revaluation surplus, right? It could be a hedging reserve, and stuff like that. But you need to consolidate all those changes in the equity, right? So the same transaction, from a journal entries perspective, how do we look at it? We say, right? So there's an initial investment which is already done. So we say debit investment in company Y, credit share of profit, which is coming through P&L, and credit share of revaluation surplus, which is coming through the OCI. Okay, so this was 2 crores, this is 1.2 crores. So the total change in the value of investment is 3.2 crores. Okay, in the books of company X at a group level, okay, in the balance sheet, you show the investment in associate at 13.2 crores. Okay, and in the P&L, you show share of profits, which is 2 crores, and in the OCI, you show share of revaluation surplus, which is 1.2 crores. Okay, so this is how the entire flow of the transaction will move in this case. Okay, but you also want to understand that if you look at any balances between, let's say there are transactions taking place, you're selling some goods, you are buying some goods, you're doing some kind of operational transactions, any balances are not cancelled out. Okay, you are not consolidating the investment in associate. There is no overlapping of a transaction, right? If you're selling something to the investment in associate or vice versa, if that entity is selling something back to you, does it inflate your revenue? The answer is no. You are never consolidating the revenue of the other entity. Does it inflate your expenses? Again, the answer is no. if there are intercompany balances, do they get canceled out? Again, the answer is no. You never consolidate any of these. That's where we're saying that any balances are not canceled out. But what you want to remember here is, and that's what we'll be doing with the help of several examples later. What you want to remember there is that you need to measure if there are any unrealized profits. And when I say profits, I automatically include losses in that. Okay. Any share of unrealized profits or losses should be cancelled out. Okay. So the key difference between what we do in case of consolidated financial statements, transactions between the parent and the subsidiary. Okay. The balances are cancelled because they inflate the numbers. They get duplicated. The balance sheet appears to be higher. Even the transactions like sales or purchases or interest payments or interest received, they all get cancelled out. All those intra-group transactions get cancelled. Even there, unrealized profits get cancelled out. 100% of those. What we are saying in case of investment in associates or investment in joint ventures from that perspective, that there are no cancellations of any balances or transactions. Okay, but any unrealized profits or losses need to be cancelled because they get reflected again. Okay, so what we are saying here is that's one difference in accounting that you would observe when you look at the accounting under 110, Ind AS 110, which is consolidated financial statements, versus accounting under Ind AS 28. Okay, we'll be seeing, of course, several examples to understand how does the accounting work. And we again use the same terms. You would remember we talked about the upstream transactions and downstream transactions as well within the consolidated financial statements framework. So they're all around. So the investor can sell to the associate and also vice versa. There could be a very clear business transaction on that. So there's no problem. What is important to understand is that we need to measure the amount of that unrealized profit. We need to measure correctly the amount of unrealized profit in case of an investment in associate and joint venture, right? We have some examples to look at when we are going to kind of solve these together. Okay, so the only thing that you want to remember that you only consolidate the equity portion. That's the first thing that you want to remember in accounting for investments in associates and joint ventures. And second thing that you also want to remember, only URP, only the unrealized profits, including the losses, only that get canceled out. Everything else is just the same way it is, right? That's what you want to remember, okay? So the equity method of accounting suggests that the initial recognition of the investment, okay, is recognized, the recognition is done at its cost, okay? And the share of net assets are included in the balance sheet in one line item, which is simply an investment in associate, right? There is no other asset or liability or revenue or expenses getting consolidated. The parent of that entity will consolidate. We will not consolidate. Okay. All we consolidate is the share of profits or even the reserves, right? Equity. That is something which is going to be consolidated, and that will appear in the profit and loss account. We just saw that example of revaluation surplus also 1.2 crores. Okay. We also saw the example of share of profit, which is 2 crores out of 5. Those are the items which appear in the financial statements or in the statement of profit or loss of the investor. Okay, and accordingly, those adjustments are given, keeping in view that there are uniform accounting policies followed by both the entities. Okay, now this could be a little difficult in practice to, to ensure, because you as an investor, you don't control the other entity. So if your accounting policies are different from what is followed by the other entity, the standard expects that you both follow the uniform accounting policies for the purposes of accounting here, right? But can you really direct that? Very likely no. So yes, there are practical issues around this, but let's not bother at this stage of life. Let's not bother about that. Okay. So the treatment in the consolidated balance sheet is that your initial cost of investment, whatever is your share of post-acquisition profit, it could be a loss also, it could be there. Of course, any investment may be tested for impairment. So even that is, that is to be kind of, adjusted from the investment value. Okay. Now, importantly, the moment we say you're paying a premium to make an investment in an associate or a joint venture, we may say the premium is goodwill, but you do not record it separately, right? You would simply call it as an overall investment in that associate, right? It's a part of the cost of investment, and you don't record it, unlike the way we have done it in case of investment in a subsidiary, right? At a group level, we do recognize goodwill, which is not the case in the given case. Of course, we said that the post-acquisition reserves, which are a part of equity, are also included, and any dividend received. Now, a dividend is essentially, right, a recovery of the investment. Okay, so dividend is essentially the recovery of investment. So naturally, the moment you receive a dividend, that the value of investment would start declining. Okay, we've already done this part, that as far as your the P&L is concerned, you only recognize the share of profits and reserves. So this would be your P&L. This would be your OCI. Okay, just a gist of how does it work. We say take the investment at its cost, add the share of profit and reserves, reduce any dividends or impairment loss. There is something at the balance sheet level. And of course, as I said, that the transactions could be either downstream or upstream. You just need to take care of it. That is there an unrealized profit, right? And we shall be dealing with those transactions with the help of several examples also. We'll be discussing specifically how does it really operate. Okay, just as an explanation, the downstream transfer would mean investor is selling to the investee, and upstream transfer would mean that the investee is selling to the investor. So that's where you look at the downstream and the upstream side. We have discussed these concepts already under the consolidated financial statements, so we don't have to worry too much about that part. Okay, the argument is that, or the question is that, how do we measure the URP and cancel or adjust under the downstream or upstream transaction? That's what we want to do now. Okay, so when you look at it, you would look at, of course, the elimination of those gains or losses under these transactions. Okay, let's try to do this. Let's try to understand this with the help of some small examples here. Okay, say for example, there's a company X, investment in 40% shares of company Y. Okay, let's say that the investment value is 10 crores. All right, now company Y makes a profit of 5 crores, right? This is something which is post acquisition by company X in our case, right? Later, company Y declares a dividend of 2 crore to its shareholders, right? So when you look at this scenario, okay, how do you deal with that part? We are saying that in the books of company X, we will say that yes, there is an investment in associate, which is company Y, because you have 40% shares, you presume to have significant influence. The investment is 10 crores plus the share of profits, which is 5 crore into 40%, that makes it 2 crores. Now, the overall value of investment is 12 crores, accrual basis, purely accrual basis, right? So this is what you got. But then the moment Y had declared a dividend of 2 crores, we would simply say that you have recovered some portion of the investment, which is 2 crore into 40%, which makes it, of course, 80 lakh. So effectively, your investment in that associate is remaining to the extent of 11.2 crores. A dividend received is considered to be a realization or recovery of investment. It's a recovery of the investment which is done. Okay. So that's one perspective. What we discussed here just a while ago, that this is how you start looking at the accounting for dividend received, right? But we now want to talk about those upstream and downstream transactions here. Okay, let's have a look at that. Company X is an investor, invests in, let's say, 30% shares of company Y for rupees 20 crores. Okay. Now we are saying that company Y has earned a profit of 10 crores, which is the post-acquisition profit. Okay. Also, company Y sold goods worth 5 crores to company X, again post-acquisition. So let's take all those transactions under post-acquisition, and or let's say at a margin of 40%. Okay, and let's say that these goods are still lying in the inventory of company X. Okay, this is a very, very specific, very clear, simple example of an upstream transaction. The investor has, which is company X, has taken company Y. Y has earned a profit, but Y also sold goods to the investor. So it's an upstream transaction. Okay, and those goods are still lying in the inventory of company X. Now, what does it mean? That there is an unrealized profit. Okay, now how do we calculate unrealized profit? We simply said that whatever is the unsold inventory, right, you multiply that with the margin, because the group never actually made that profit. Okay, so we may argue that the sale of 5 crores with a margin of 40%, that gives 2 crores as the let's say margin which is sitting in the inventory of company X. But then this is not the way we want to do it. This is something which is very clearly done in case of an investment in subsidiary. You take the 100% of the margin with respect to that unsold inventory. The moment it comes in connect with an investment in an associate, or a joint venture, we say that what is that you are taking back in your books as an investor, right? What is that amount of profit that you are taking in your books from the investment in associate? You're not taking 100% of the profits the way you do it for the subsidiary. Okay. For the subsidiary, you take the 100% profits, your share as well as the NCI's share. Okay. In the case of an investment in an associate or a joint venture, you are only looking at the 30% margin, 30% share of that profit. So the overstatement of that profit or the unrealized portion of the profit is restricted to your stake in the investment in associate, which actually means that my URP, unrealized profit, should be calculated at 2 crores into 30%, which is 60 lakh. Okay. So the way you want to understand this is from the investment purposes. So company X would say investment in associate. Okay. The cost of the investment is 20 crores plus share of profits, which is 10 crore into 30%, which makes it 3 crores. But out of this 10 crore, a profit of 2 crore is earned by, company Y. Okay. And out of this 10 crore, you are only taking back, you're only consolidating back 30%, which means that the URP should also be taken at 30% value, which actually means that your net investment in that associate will be taken at 22.4 crores from this perspective. Okay. Now, this is the contextual understanding. What you want to understand here as a formula or as an approach is that in case of an upstream transaction, which is, for example, sale by associate to investor, right? You would say debit profits, right? The share of profit. Okay. And credit investment, right? Rather, sorry, my bad, credit the inventory, because that is the inventory which is sitting in the books of the investor, and that's get consolidated. So you would simply be accommodating or adjusting that profit against the value of inventory. Okay. So the 60 lakh rupees is not only getting reduced from the share of profit. So effectively, the profit share is only 22.4, 2.4 crores here. Okay. That's what you want to remember. So we are saying that debit that share of profit, credit the inventory, because the inventory of the investor appears in the consolidated financial statement of that investor itself. Okay. However, if it were a downstream transaction where investor sells to, okay, the investor sells to the associate, right? Now, what would that imply? What does it imply? it only has one implication, that the profits of the investor are increasing, or the profits of the investors have increased, and the inventory of the associate is getting increased. But do we consolidate that inventory? The answer is no, we do not do that. Okay. So the impact that we take as far as a downstream transaction is concerned, we still reduce the profit share. Okay. But the impact is made through the investment in associate. Okay. Effectively, you're still doing it this way, whether the sale is made by the associate to yourself under an upstream transaction, or by yourself as an investor to the associate under a downstream transaction. Impact is eventually the same, but what we are trying to say is that here, since the inventory of investor had inflated, so at the balance sheet level, you would see the impact. Okay, not on the profitability level. Okay, so in the balance sheet, you would have only taken in your investments 22.4, because you only take the net share of the profit, which is 2.4 crores, and your inventory would have been separately reduced. But the moment you say it is a downstream transaction, since the inventory never got captured, okay, the inventory of the associate does not get consolidated. So you're taking only the profit share and you are adjusting it against the value of the investment. Okay, we will have some questions to discuss these perspectives more in detail, but the whole idea of accounting, as we try to understand it and with the help of these examples, is to identify that it's not fundamentally or conceptually different from what we have done, let's say in case of consolidated financial statements. But here, the objective or the the treatment which is being done is to be seen from the share of profit, 30% share, 40% share, 25% share. So that kind of distinction is required to be made. So only a portion of the unrealized profit that needs to be cancelled out or eliminated under this particular case. Okay, so let's have a look at this example. It says that during the year end 31st of March 2020, Alpha Limited acquired 35% voting interest in Beta for 23,000. This is classified as an associate. Okay, so that's already provided. The goodwill on acquisition amounted to 2,000 rupees. The fair value of Beta's net assets is 65,000. Determine the following for the year end 31st of March 20, which is the carrying value of investment in Beta in the group balance sheet, and the share of profit to be included in the consolidated statement of profit or loss. Okay, now there's a very limited information provided. Let's try to understand this better. You have acquired a 35% voting stake and you paid 23,000 for that. Okay, you paid a premium out of that 23,000, which is 2,000, which essentially means that the 35% value of the business, right, of Beta, of course, would have been, since you paid a premium of 2,000, the value must have been 21,000. Okay, for 35%, right? So what is the value of the business in totality? So 100% value of the business would be 21,000 divided by 35%, and that amounts to 60,000, right? So when you acquired the business of Beta Limited, the business's worth, the 100%, the value of the business was 60,000, and you acquired 35% out of that, which had a value of 21, but you paid 23. Now, as we discussed, that goodwill is not shown separately. The goodwill is not shown separately. So you would say that your investment in that entity is 23,000 on the date of acquisition. Okay, right? And it is also provided that the fair value of Beta's net assets at the end of the year is 65,000. Okay, so what do you want to remember now, right? Value of Beta on the acquisition date is 60,000. Value of Beta on reporting date is 65,000, which simply means that there's an increase in the value to the extent of 5,000 from the date of acquisition. There's an increase in the value of Beta to the extent of 5,000 after you had acquired 35% stake in that company. Okay. Do we agree that 35% of this pertains to alpha? That's what we are saying. Consolidate equity, your share of equity. Okay. So what I want to say here is that alpha's investment in Beta, or let's say on 31st of March 20. That's what is the reporting date. Let's double confirm that. That's what we got. We are saying original cost 23,000 and share of change in net worth, which is 5,000 into 35%, right? That is 1,750. Okay, so that becomes 2,4,750. And that's what, by the way, is the carrying value of the investment in the group balance sheet. Okay, and as far as the share of profit is concerned, we already got this number, right? So the 1,750. This needs to be shown in the consolidated profit and loss account of Alpha Limited. Okay, that's how you approach the question. It's a very straightforward question, but yes, you need to be careful about it, that you need to bring that value of Beta Limited on the acquisition date at its 100% value. Okay, let's have a look at the formal solution. We are provided that this is the cost of investment. So the worth of the company is for 35% stake is 21,000. The overall worth is 60,000. Investment in Beta would be original cost plus the share of profits, and of course, the share of profit is also a part of the profitability from the in the consolidated P&L of Alpha Limited. Okay. This is another example. It says that on 1st of January 20, Mars Limited acquired 40% stake in Venus for a consideration of 5 lakh rupees. And during the year, Venus made profit of 1 lakh and paid a dividend of 50,000 rupees. The question is determine the carrying value of the investment on 31st of March 20 using equity method. Okay, now this should be very straightforward. We have done these already, these kind of. The cost of investment is given at 5 lakh, okay, plus share of profit, which is 1 lakh into 40%, 20,000. You add that minus dividend share, which is 50,000 into 40%, which is, sorry, this is 40,000, my bad. This is 20,000. So effectively, the investment, the carrying value of the investment as on 31st of December will be 5.2 lakh rupees, right? That's something which is a very straightforward calculation that we could do. Of course, there's a bit of an explanation further. If there is a change in the value of investments through the OCIs, any kind of translation reserves, hedging reserves, revaluation surpluses, etc. So they have to also impact the value of the investment. In the given question, that may not be relevant, but in practical life, you need to be carefully assessing that part. You cannot ignore that part. When you look at the value of the investment, you need to bring all those contexts together. Okay.